Hello, money and banking students. Hope everyone is having a good weekend. We're quickly approaching the end of the course, so make sure to wrap up everything from week 6 and then get started in week 7. For week 7, you're going to look at chapters 19 and 22. Chapter 19 should be a little bit of review from macroeconomics if you had that before, which I think you should have. And looks at kind of the roles and responsibilities of the Federal Reserve and ties in more into money and banking. So you learn a little bit more detail about the structure and its relationship with the banking industry. Chapter 22 is a little bit more about the meat and potatoes of this week. That's a little bit more technical read in this chapter, but it deals with the potential intervention that the Federal Reserve can have in the foreign exchange markets. So you'll learn a little bit of detail about the capital account, the current account, the balance of payments. Right now, the US dollar has been strengthening for the past year. And that is something the Federal Reserve has to think about, because if the dollar is strengthening, that means appreciating in value compared to other currencies. That also impacts our trade. So it is going to increase that gap of the trade balance, because now our goods look more expensive to foreigners, and that can have an impact on the economy too, because exports are part of GDP. So we, after looking last week at the Federal Reserve probably potentially raising interest rates in September, there's still a lot of caution out there by Janet Yellen and the Fed members that how quickly they raise rates, because that's why they're watching all these things very closely, all these different variables about inflation, unemployment, GDP, and yes, even the strength of the US dollar. So they got a lot on their plate right now to analyze. And I put an article out there that was posted about a month ago that kind of describes a little bit more details about these relationships the Fed has to think about. And in the news, if you pay attention, you might hear once in a while about the strength of the dollar. Now, I remember the days that the euro cost about $1.30, and as of Friday, it cost about $1.10. So how this works, if it costs less and less for us to buy a euro, that means that our US dollar is appreciating relative to the euro. So for Europeans, that means that if they want to buy more US dollars, it's requiring more euros on their behalf. So that's why they mean that it's strengthening. So as a fun exercise this week for our last form discussion, what I want you to do, and it's very important that you do this early in the week, otherwise you're not going to receive full points for the forum discussion. And it's a very simple forum discussion. I just want you to give a prediction of where you think the euro is going to close on Friday, August 7th. So as of this past weekend, it cost American $1.10, 1.1010, to buy 1 euro. Now, if the euro appreciates in value, that would mean it would go up to like $1.12 or $1.13. But if the euro depreciates in value, that means it would require us less dollars to buy it. So maybe it's at $1.08 or something like that. Now, I don't expect a lot of fluctuation in the price in 1 week, but it'd be interesting to see where it does close at the end of the week. So again, I want you to post out to 4 decimal points, but the person that posts the closest, and you have to do this before Thursday at midnight because we're going to base it on Friday's trade, will win a box of Twinkies from me, your professor. So I'll make sure to make arrangements and get that to you in the mail. So, but other than that, just make sure to jump in early to that forum discussion, make your post, get those homework problems done for this week, get your readings done, and if you have any questions, do send me an email. But otherwise, have a great week, and we'll talk to you later.